Alright, so let's jump into part 8, I believe, of our advanced fundamental analysis discussion. We're going to talk about, I'm going to talk about profitability a little bit, starting with effective tax rate. So you may or may not know that the corporate tax rate in the United States is 21%. However, we all know, well, maybe not all of us, but a lot of us know that a lot of corporations don't pay nearly as much as 21% in taxes. So effective tax rate gives you excuse me, gives you the accurate picture of what any particular company is paying in corporate taxes. So looking at Apple here, um, the effective tax rate formula is you take the earnings before interest and taxes and you divide that number uh, into the income tax expense. So for Apple, that was about 10.5 billion for fiscal year 2019, and then you divide that by the 63,930. That gives you a little bit over 16%, which is lower than 5% lower than that 21% corporate tax rate. So, that's just smart business. You want to pay as little in taxes as possible to boost your bottom line. So, remember, don't assume that all corporations pay 21% in the US. That's not the case. You have to go in and calculate the effective tax rate to know exactly what the company paid in taxes for any given year. And so, in keeping with the effective tax rate, we'll talk about a formula called NOPAT, NOPAT. So, NOPAT simply stands for net operating profit after taxes. So, this number allows you to compare companies in the same industry minus the impact of their capital structure. So we know that companies structure themselves via debt or via equity. So not every company capital structure is the same. So when you have those numbers, it makes it complicated to compare those companies. So NOPAT takes out the impact of that capital structure and allows you to investigate the company's operating profits or potential operating profits um, against companies of the same industry. Um, so it's hard to do that. So you can't look at, let's say, Qualcomm and Qorvo and say, Qualcomm is a better company because their net operating profit is higher than Qorvo. You would have to look at the capital structure. You would also have to look at that capital structure, which makes it really, really muddy. So NOPAT allows you to just say, forget all that. Let's just look at the net operating profits. So calculating net operating profits is after taxes or NOPAT. You take the net operating or you take the operating income and you divide it by 1 minus the effective tax rate for that company. And then that gives you the potential um, operating profits sans any other capital, sans leverage. We'll say that, sans the financial leverage for that company. Um, and that's pretty much it. When it comes to NOPAT, that's pretty much all I have. Um, and the reasoning for my mentioning NOPAT will become more apparent in future videos when I talk about, return on invested capital and things like that. But for the purposes of this video, that's it. I wanted to make it short and sweet. If you guys have any questions about effective tax rate, ETR, or NOPAT, hit me up and I'm happy to field those questions. If you have any comments, of course, I'd love them. But thanks for watching, y'all.